All right, everyone. Just some ground rules. The question answers will be handled by Ashna later on during the session, and this session is being recorded. So we're gonna share the recording later on once the session is completed. And please keep your mics on mute so that the speakers can continue. And if you have any questions, please raise the hand, and then Ashna can coordinate to take it up. So good evening, everyone. Before we start, I wonder if everyone is thinking the same thing like me. The weekend is officially calling, and yet here we are tackling a complex but crucial topic. Some of you might be picturing a relaxing dinner, a late night movie, or even catching up on sleep. But before we switch off, we have one last important thing to do: stay ahead of the game in corporate tax filing and e invoicing. After all, the UAE corporate tax landscape isn't taking the weekend off. With corporate tax return filing now a reality, businesses are navigating new tax compliance requirements, return filing complexities, and practical challenges in reporting. At the same time, e-invoicing is set to redefine digital landscape, tax landscape in the region, mirroring global trends towards automation, transparency, and real-time reporting. These changes demand not just awareness, but a strong understanding of their impact on the financial and operational workflows. But let's be honest, even the best of us make mistakes when dealing with new regulations. Here are some classic examples. Like corporate tax blunders could be misclassifying expenses, failing to report related party transactions correctly, or even missing deadlines. Yes, missing deadlines is a reality we always hear all the time: penalties, removal of penalties, and all that. And then e-invoicing confusion. The much popular e-invoicing is not far off. We are going to see it next middle of next year at some point. So it's not very far away. Many of us would assume e-invoicing is just about generating invoicing or linking with government platform. But in reality, it also involves structural data formats, real-time reporting, and many other regulatory compliances that comes with it. So to ensure you don't fall into these traps, we have an incredible lineup of speakers today. CA Aarti Yadav and CA Pooja Kabra will take us through the ins and outs of filing UAE corporate tax returns, while Abdullah Javed will shed light on how e-invoicing is evolving and what businesses need to do to stay ahead. So a huge thank all the speakers for taking their time out and be with us today. And of course, a big shout out to our executive committee member, Ashna Mulgaonkar, who has seamlessly coordinated this session for all of us. So let's dive in and make most of this session. And before we moving forward, I'd like to request our chairman to say a few words. So Maniji, over to you.
Thank you, Rishi and Asna, and welcome all of you. And thanks to Aarti, Pooja, and Ahmed for joining us today to address their expertise on two most relevant topics. As you know, this is the first year of income tax return filing in the UAE. It is very important that all compliances take place in line with the required law of the land. Otherwise, it may be a costly affair, and any lapses can put into different type of non-compliances as well as the. So, as you know, this corporate tax is evolving subject. Still, a lot of clarification keeps coming, and we also get new experience, practical problem. So it is always good to listen expert of the field who are already handling these topics with their organization as well as the lot of clients. So welcome all of you, and thanks Asna for arranging this again, the very important webinar on the very live subject where everybody wants to learn something and everybody feel is incomplete, and any lapse, any incomplete knowledge can get better for by learning the new subject, new things. So over to you, Asna, and thank you very much for all of you to have a most learning webinar today.
Oh, sorry,
Thank
yeah,
you.
just 1 second, Ashna. Jay, I think, is not there, our vice chairman. So I think let's move into the topic. So Ashna, over to you. Let's go into the subject. Thank you.
Thank you everyone for joining. Thank you, Rishibai and Somani sir, for those lovely words. Yes, the topic is very relevant now. Everybody is focused on corporate tax and way forward e-invoicing. So, thought of doing a webinar on this. And thanks to our speakers who immediately said no worries and they started working on their PPTs. So, let us first introduce Mr. Abdullah Javed, who is joining us all the way from Malaysia. He's a global product manager, Skill Quotient Group. He's seasoned expert in digital transformation and financial technology with over 10 years of experience driven innovation. As a key figure in one of the leading organizations, Skill Quotient for e-invoicing, he has guided numerous businesses through the complexities of digital billing, compliance, and automation. With significant success in APAC region, particularly in Malaysia and Singapore, Abdullah now leads efforts to help businesses in the UAE to adopt the e-invoicing solutions and ensure the regulatory compliance. His expertise in global e-invoicing trends, including the PayPal framework, positioning him at the forefront of the UAE digital transformation. So without taking much of your time, let us welcome Mr. Abdullah to take us through the compliance network of e-invoicing today. Abdullah, over to you.
Well, thank you very much, Ashna, for the introduction. And I would first like to welcome everyone because, as Mr. Rishi mentioned, these two topics are very crucial for the regime and how UAE would be adopting this specific e-invoicing and what would be the regulation, because it's at this moment in UAE, it's a hotcake for e-invoicing. Every other person, either he's in corporate functional or technical side, they are all looking forward to the challenges and how they would be adopting as a corporate, as an entity for this e-invoicing regime. So I have a few segments to share with all of the audience today. So allow me to share the screen and then we go into that for it. All right, Ashna, would you please check and see if my screen is visible?
Yes, we can see.
All right, perfect. So the topic which I would be deep diving into is that how UAE would be converting the paper to the pixels, from paper to digital. What would be the evolution of e-invoicing in the UAE region, and how the companies need to get onboarded and adopt this e-invoicing regime. That was quite a difficult by the given time to see what would be the agenda for this discussion. But these are the 6 segments which I would like to share with the audience for the e-invoicing and the relevant technicalities which we need to unfold to get this bus on time for the UAE e-invoicing regime. Starting with the first one, I would cover in this session the e-invoicing, how we unfold this particular statement. E-invoicing, is it like just a digital invoice, or what would be the difference? And a second would be the global e-invoicing trend, not only in UAE, and I would say UAE is not the first one adopting e-invoicing, but what is around the globe for this regime. And third area is most crucial for the audience here, because what is the vision of Ministry of Finance behind this e-invoicing regime, and what are the expectations from the authorities after just having this taxation? And recently we are just onboarding, we are just getting the pace for the taxation, and now e-invoicing comes up to the picture. So that's for the agenda 3. Fourth is a technical body, which I would be highlighting here would be the PEPAL, and what is the framework, how ministry is aligned with the centralized body. And then comes to the positioning for success. If the company, if any entity wants to get ahead of the other in this regime, so what would be the position? And last, we would be having a interactive QA session. You would park your questions or your confusions at the end. And with Ashna's support, I would try to maximum cover up or try to answer these questions. All right, so first point here would be e-invoicing. How is it uncovered? How is it unfolded? And The definition of e-invoicing here, as you can see, is an electronic format. And why I have said electronic format first, and then I comes to the structured one, because if anyone says that I'm moving from paper towards an e-invoice, it's not at all saying that we are just having a digital invoice and that means we are getting an e-invoice for the company. No, it would not be the case. The structure should be there, and what structure should we follow for UAE invoicing, that I'll cover in the next slide. So the second point here is the agenda. What defines the e-invoicing and what is the key benefit is to just automate the entire invoicing process. UAE is now rapidly moving towards the digital age, and how we need to transform from manual efforts to human intervention to the automation and how the things would be operating. So that's how e-invoicing is coming into this region. Here you can see a standardized format, which is XML. This is a bit technical in nature, but this is a machine readable format. And for all e-invoicing, this is the only mandatory format that would be required for every company to have this in their ERP. Then only they can transmit their invoices to the authorities using the PayPal
Because
framework.
of the tax come now.
Next is a seamless data exchange. How ministry is picturing up the e-invoicing regime is to just have a data exchange and they would provide the centralized environment for it. Second bullet here is the key component of e-invoicing. For sure, there would be a standard invoice and the relevant adjustment notes for the e-invoicing. But what are the specific things which all the companies need to, all the businesses need to adhere before getting into this picture? So there are the mandatory fields, data fields, which should be there for a standard e-invoice document. And referring to this data field, UAE Ministry has launched a consultation paper that says that around 50 mandatory fields should be there in the standard e-invoice document. Just in a layman language, if I say if you're an entity, you're having an e-invoice, but the data fields out of 50, you are having just 25 coming out from your ERP, then sorry to say you're not compliant to the ministry, you're not compliant to the PayPal authority, and you cannot operate the business in terms of e-invoicing. Next one is a real-time validation. At this point in time, if you're getting into the paper invoices and all, there is some time lag, there is some delay in the approvals and the invoice formation towards the payment management. We call it order to cash management. So there, at this moment, there is a delay definitely in the UAE environment for order to cash management. So e-invoicing is trying to enhance and adhere to this efficient environment as well. So standardized format for the cross-border exchange, that means e-invoicing regime, they have a roadmap to centralize everything, to standardize the format, not for one region, but definitely to the other regions as well. Because UAE being the hub of the business, and we are planning to get the corporate onboarded, since we are into discussions that West world is now moving to the Gulf region and UAE is adopting the things. So cross-border exchange, digitalized trade is very important here. Benefits of e-invoicing, I can have a list of tens or twenties of more benefits in e-invoicing considering the adoption in other regions, but the few of them are the reduced cost. Administration cost would be reduced and the human intervention would be decreased by the adoption of e-invoicing. And real-time validations would be very beneficial for the entity itself, not just for the authorities. So entity would be having the validations in case there is a loop, there is a gap which they need to adhere with their customers. So they need to have the validations because if there is some error, you can at the very first place cannot send this invoice to the authorities. And if it's not sent to the authorities, you cannot get this validation and neither you can proceed to the payments. So that's sort of a bit challenging for the companies, but of course there are the solutions available. There are the providers available in the market who would assist you guys in the regime and the adoptions. Next slide covers to the definite comparison between e-invoicing and the digital invoicing. Of course, we are moving from paper to the digital regime, but just to say that it's a digital invoice means it's an e-invoice, that's completely wrong statement. So I would clarify the differences. A digital invoice may or may not have the structured format, but if we talk about the e-invoice, for sure there should be a structured format. And PDF only, or the images, or you would say email sending to the customer with an invoice is not sufficient for the e-invoicing. As I mentioned in the previous slide, XML format would be the only mandate that would be followed in UAE for the e-invoicing transmission between supplier and the customers, as well to the tax authorities. So the common misconceptions, which I hear from the consultations in UAE, is that is there any customizations for the companies who are not having the big giant ERPs, just excluding SAP or Dynamics? If a company saying that yes, I'm a supplier, I need to get the e-invoicing adoption using your consultation, but still my ERP is not having the mandatory data fields, which are 50. At this moment, ministry has announced the 50 fields should be there. So that's a big no, because every company should have the mandatory data fields. Only then they would get the e-invoice validation from the authorities. So both supplier and buyer should follow the same interoperability network. This is a word interoperability network, which Ministry of Finance has already chosen that they would be following the PEPAL framework. At this moment, I would not be deep diving into the PEPAL framework. I'll later on discuss. But yes, there should be a centralized network. Any company cannot go beyond that network, cannot submit the invoices straight away to the ministry, cannot get the validation, in short. So the scope of e-invoicing number 3 in this slide is just not to reduce the cost for business, but also to groom the economy of UAE. Because as compared to paper invoice, if we are going towards e-invoicing, first of all, VAT leakage would be minimized, and ministry is very keen to get this one, because if I recall the global landscape of e-invoicing, if I specifically talk to APEC region, there are the stats that around 66% of the VAT leakage is minimized in some certain regions due to e-invoicing. So that's a huge count. And in terms of administrative cost reduction, there are around reports that says that around 40 to 45% admin costs are reduced, and the human intervention is turned out to the automated process. So that's if we talk specific to the numbers, that's the count and how we operate with it. Next one is a global invoicing trend. I would not take much time on this one. You guys are already aware of the e-invoicing regime, but in short, Europe is leading this adoption, and driven by the major countries in Europe. They are planning to have this e-invoicing starting from 2025 till 2030. They are planning for entire roadmap to get this e-invoicing regime. A few of the regions are there already adopted e-invoices, but if I count on the tips, Belgium, Germany, France, Poland, they are yet to announce e-invoicing, and followed by the United Kingdom. They are also in the discussion with their ministry, HMRC. So there would be a mandate in the future. Success stories so far on top of my head is the major Asia Pacific region that we called Malaysia and then Singapore. Malaysia, they announced e-invoicing back in 2024, and they were quite lenient for their taxpayers because there was a phased approach. Phase 1 starting on to the August 2024, then January, and then recently they announced a leverage for the third tier companies for the another 6 months grace period. So yeah, that grace periods are announced by the authorities to get taxpayers onboarded with time. Third part here is technologies. We cannot skip just technologies and move towards the functional side, taxation only. Technologies which would be used for e-invoicing, AI, I would strongly recommend, because this validations, Gen AI, chatbots, these are being used for e-invoicing in the other regions. And even the tax firms and the corporate sector, they also want this AI combined within e-invoicing. And why I have mentioned cybersecurity and cloud hosting is that there must be some data which is captured for e-invoicing. So data archivals, data storage needs to be protected. It's a sensitive data to share the payments for the customers. So that needs to be there. So cybersecurity is very strongly recommended to go and get connected for the e-invoicing solutions. Next one is the strategic objectives and the value propositions. I would count on my tips. The cost saving is for sure. Enhanced supply chain management, as I mentioned, the order to cash management, this is pretty much enhanced. And there are the success stories in other regions where the cross-border trade is very easy. The harmonization between supplier and buyer is very easy, even if they are not business to business. if there is someone who is end user, just like me or you. So if we go to a grocery store, I'm talking giving a live example from Malaysia. If you're having a certain purchase, we are still getting an option to see the e-invoice. So yeah, there is a centralized environment, and we just get to the QR code which is provided by the vendor. When I just click on the QR code, they get me straight to the invoice. That's the authority portal. So that's how this enhanced, and UA is also having the same expectation from the B2C environment as well. So the compliance and transparency, for sure, VAT leakage is minimized. Compliance should be 100%. Data fields should be there by each and every supplier who is generating an e-invoicing. This should be there. And cross-border trade, most likely if UAE invoice is generated and moving towards Europe, any other APEC region, or primarily to Kingdom of Saudi, so there should be enhanced cross-border trade. And I'll later explain what would be the synchronization for this e-invoicing and the cross-border trade. Now comes the most crucial part for the audience, is that what is the vision of e-invoicing in UAE, and is it like slightly different from KSA, or is it like replicating APAC? Is it with European region, or is it standalone the UAE regime? So in a nutshell, if I would go to the next slide, we are exploring the proposed model, and the overview of the model is that UAE e-invoicing is mostly focused on the financial transactions and the tax compliance. The primary, with if we consider their announcement and the timelines, the primary focus is just to have the more economic stability, just to minimize the VAT leakage and to get the cross-border trades which are in a harmony, which are centralized. So that's the major agenda for UAE invoicing. And the features and requirements I already mentioned, we have as of today, we have the mandatory 50 fields, but cannot assure that ministry can increase or decrease given in the next phases. Because if I quickly recall Malaysia's e-invoicing data fields, you must have believed that first there were 32 mandatory fields at the very first phase. Then it comes to 55 mandatory, and then at this moment we have 69 mandatory fields. That means every company, every business need to comply to these data mandatory fields. That was a challenge to adopt in the businesses in Malaysia. But now once they are streamlined, once the companies are ready for the e-invoicing, they are going with the flow. And that's very much appreciable by the ministries as well. And same expectation goes for the UAE as well. Implementation timeline, I haven't dropped down the list of the timeline here, but yes, starting off in July 2026. Ministry has straight away clearly mentioned that July 2026 would be a mandate for the businesses to get this e-invoicing. But before that, we are open to have the onboarding of e-invoicing. What onboarding is that? Sooner, because 28th of Feb was the last date for consultation paper by ministry. So if you guys ask me, at least 2 to 3 weeks or latest by 1 month, there should be some PEPAL authority which is announced in the UAE. So that PEPAL authority would be the centralized body which would be transmitting the e-invoices from supplier to buyer and then to the tax authorities. So yeah, everybody needs to get on the buckle up and to get the pace for this e-invoicing regime. It's earlier the better, because July 2026 would be a mandate, and there might be some grace period, or there might be some fine and penalty for the businesses. Cannot say at this moment, but there are the two approaches. But it's better, strong recommendation from the other experts as well, that it's better to get on board before time. This slide is very much interesting in terms of the comparison for these two neighbors, UAE and the Kingdom of Saudi, because many of you are aware of the Saudi e-invoicing, which is followed by Zatka and Fatura portal. So they are not having any third-party centralized body which is managing the e-invoicing. Zatka is directly accepting the e-invoicing from the taxpayers, from the businesses, and then it's validating. So that's the first and foremost difference in Saudi and UAE invoicing. In UAE, we cannot straight away send the document to Ministry of Finance saying they get it validated and we need to send it to the customers. That would not be the case. PayPal would be there, and how good it would be to adopt PayPal, that I'll discuss in the next slide. Unique aspects of the UAE approach. Unlike Saudi, UAE would not have this much phases for e-invoicing. That's not yet announced, but they have a standard deadline of July 2026. Because if I recall, Saudi, they started off with their first phase with 32 billion revenue suppliers, and then at this moment they're around more than 20th phase of e-invoicing with some amnesty schemes and the grace periods. But unlike UAE is having a more aggressive approach, just one clear deadline, July 2026, and need to get adopted to it. So that's the difference. And if you guys ask my opinion, that is a good approach because we already know as a business being operated in UAE that this is a timeline provided by the ministry. We need to get adapted to it. So everybody should be ready. People are now getting in the market, the heat is already there. People are hiring the consultant, getting their ERP wet by the consultants, by the tax experts, because data dictionary is already out there. So yeah, moving to the next slide, it's a bit technical in nature, and I would be referring to the more technical things. So audience in here who are inclined toward technical, not just functional, would be very much familiar with this PEPAL framework. So understanding the PEPAL model, if you skip five corner, understanding the PEPAL model, overview of the network. PEPAL is a not-for-profit organization based in Central Europe who is managing the regime of e-invoicing, not only in Europe, but for the entire globe. And PEPAL is having, if we talk about numbers, around 80 to 85% regions for e-invoicing would be following PEPAL as a mandate. And why I refer in the previous slide about the centralized body, centralized environment for the cross-border trade, that would be managed by PEPAL network. PEPAL would be holding the e-invoice centralization between different regions and would be having a standard format. The first point here, as I have written, network that enables cross-border procurement and e-invoicing. That's a network would be announced by the UAE as well. Of course, it's definite UAE would be following PEPAL five-corner model. That's obvious. Now, what the ministry is under discussion is what would be the body in UAE which would be governing this PEPAL authority. Because every region, there is a specific third party, or there could be ministry who would be having this PEPAL authority. PEPAL is a global organization. In every region, they have their authority. If I recall the names, Malaysia, we have MDAC as a PEPAL authority. Singapore, we have IMDA. And similarly with Europe, we have the ministries themselves managing the PEPAL authority. So yet waiting for the UAE to announce the authority. But as soon the authority is there, there would be some service providers who would get accredited by the authorities. And as a business, we need to get in touch to those service providers because they would be they would be a bridge between PEPAL and your business because you cannot directly go to the tax authority. You need a PEPAL framework. It's in a layman language, it's a bridge between Ministry of Finance and the business. So either like or dislike, PEPAL service providers would only be providing the invoices to the tax authorities. Role of access points, as I have mentioned, service providers, they would be referred as access points by PEPAL. So any service provider would assist the business to get their invoices connected to the authorities and to the buyers using the PEPAL framework. Down there, you can see there are five corners. Corner one starting with the seller, who is the supplier. So I will try to explain with an example is that we are a business A is the seller. They are trying to sell something to business two, which business B, which is a buyer, corner four in my display. So these two are the businesses, they have the sale and purchase. And where comes the access point is a corner two and corner three. So these access point cannot be any tax party or any third party until and unless there would be a PEPAL accredited access point by UAE Ministry or UAE PEPAL Authority. Only then you would be having this connection through these access points, corner two and corner three, and then you would be moving toward your invoice towards corner four and then corner five. Because the ultimate decision would be the tax authority. So these access points, what they will do, they will accept your invoices and they will transmit to the buyer as well as to the tax authorities. And the benefits of using this PEPAL framework, it promotes interoperability, it promotes centralization, it promotes the seamless exchange of invoices. And there is a standard format. I would not deep dive into it because if we talk about PEPAL, there would be an entire discussion, technical in nature. But Standard format is PayPal Business Identification Specifier 3.0. So that is 3.0 format which is being used. And of course, with other regions, in Malaysia, they have their specific data dictionary. Singapore have their separate, European have their separate. So that UAE would be announced with a PayPal International Data Dictionary, which would be PINT UAE. So every business need to follow this PINT UAE. And if you're, I'm sure there would be many questions on this technical PayPal thing, but you can drop in the chat later on, and then I'll try to answer maximum of them. So last one is the participant ID for both suppliers and buyers. What is a participant in PayPal network? Consider this as a corner 1 and a corner 4. Corner 1, giving my example again, is a business A, and corner 4 is a business B. So corner 1 needs to be a participant and corner 4 needs to be a participant. That means I would be given by the PayPal authority a specific participant ID. So every business need to be getting their participant ID from the PayPal authority just to operate and to get the invoices transmitted. And there is a unique participant ID for each region. If I talk about their format, the first 4 digits would be the region UAE in this discussion, and followed by the tax identification number or the relevant VAT number for the organization. So this way, participant IDs would be there, and that would be onboarded with the service providers, the access points. And if I closely monitor this access point, that means they would be having a middleware role where they would be providing the invoices to the tax authorities as well as to the buyers. So this is the role of access points. There are plenty of access points, service providers, but all the businesses need to ensure that the success point should have a history, should have a success story in the different regions. And this access point should be PayPal compliant, should be an open member. So these are certain factors need to adhere by choosing the access point. All right. Moving to the next one is the positioning for success. What would be the position for strategy for the transformation? First is the assessment and planning. At this moment, we are on a stage that we need to assess and plan for this thing, and then technology selection, and then change management. What assessment would be is that if I'm a business, is my ERP having these mandatory data fields? Yes, then good to go. If no, I need to add these fields and I need to plan accordingly. I need to get some tax advisory, need to get some service providers, need to shortlist the service providers and get them onboarded, shake hands with them. So yes, you guys would be getting assisted by your service providers to enhance your e-invoicing through the mandatory data fields and the connection within the PayPal network. Technology selection is that what PayPal access point you would use. Is it compatible with your ERP? Is it good for the connectivity? Or what is their success story? Would that be a longer run business collaboration or not? So choosing a success point is a very critical situation for e-invoicing especially. And customization for current e-invoicing data fields, you cannot customize, but of course you can customize the invoice header, you can customize the additional fields which you need, but still mandatory fields should be there. Change management, this word is very close to my discussions within different regions as well, because e-invoicing, paper to pixel, paper to digital is a big change for the business, for the economy itself. So if I recall the success story in Singapore, actually GST is not a mandate in Singapore, but they announced the e-invoices, and service providers and the consultants like me, they adhere to the companies who were moving, who were very aggressive for this change management. So yes, their e-invoice mandate is not followed, but the companies who are yet adopting the e-invoices are having their reduced cost, are having their efficiency in their order to cash management. So as I mentioned in the previous slide, it's not just a mandate from the authorities, it would be monetary and non-monetary benefit for the business, for the organization itself as well. And last point, in the right corner, you can see in-house training to adopt e-invoicing. That means your finance, your taxation, your technical teams should be aware of the data fees, should be aware what e-invoicing is having. So this in-house trainings and getting the trainings by the experts, by the consultants is very important to get this adoption. So next is a future of e-invoicing. Not just tax compliance, e-invoicing, I must say, is a digital world, which of course Europe has announced till 2030 they would be having this mandate for many of the regions. But if I specifically talk about the UAE region, the enhancement for e-invoicing ministry would not be just staying for the first stage in July 2026. It would then emerge the trends and the predictions, how economy would be sufficiently able to adopt e-invoicing. Because for UAE, even taxation was a baby child was a new thing in UAE. But yes, so far, if you recall corporate taxes, the things are going in a good pace. Now in e-invoicing, they need to emerge to the trends, need to have some predictions, of course, following the Saudi government's protocols for e-invoicing, not just in terms of connectivity, but in terms of the leverages being provided to the business. So that either they be amnesty schemes, there may be grants, because many of the regions, just like in Singapore, they're providing grants to some companies who are adopting e-invoicing. The earlier, the more grants. So that's the ease for the business. And at this moment, I'm not sure what ministry would be announcing, but yes, this would be a emerging trend for the businesses itself. And down there, you can see the impact of AI in automation. For the e-invoicing, I have seen many of the solutions which are catering AI and how AI can help you out. The foremost thing which would be interested for the audience is the tax compliance and the tax reconciliations. There would be reports, there would be some data driven strategies for the tax compliance, because not only the ministry is trying to get this VAT leakage avoided and the tax compliance 100% rate. In fact, the business is also needed. And if I recall the Malaysia and the APAC regions, before e-invoicing, there were some loopholes in the businesses. Either they're reconciling their tax at the end of the year. Is it easy or not for the paper invoice? Because I personally have seen the gap, the loophole between the tax reconciliations. So once we go for the e-invoicing, we are open for the reconciliations because everything is on digital nature. Everything would be there. Not only your ERP would be reconciling, a third-party solution provider can also reconcile your invoices. That yes, your ERP is saying that this is X amount of invoices, X amount of tax paid to the ministry, but the solution provider says that this is Y amount. So reconciliation differentials would be mitigated before you file the tax return every year. And the role of blockchain, again, technical in nature, I would not deep dive, but the blockchain would be improved, the security and transparency would be improved with the invoicing. And how it would be improved is to mitigate the risk of frauds, disputes, cross-border transactions with the time. So this blockchain environment would be there. And that's not just for UAE. These points I have picked from the emerging e-invoicing regimes in the different regions. So it was hard to find these points, but yes, that's the major component. Beside the tax compliance, this would be there for e-invoicing. And we are already there. Interactive QA session. So this is it from my side for the e-invoicing, PayPal compliance, and all other different areas. And I would like to address the questions. You can key in the chat, and Ashna, I would like to have your support to get these answers.
Thank you so much, Abdullah. It was a fantastic session. We have a lot of questions in the chat group here. The first one is from Jasleen. Is this for B2B or B2C sales? E-invoicing is for B2B or B2C sales?
Okay, so to address this one, for July 2026, it comes for businesses only. So B2C would not be a mandate at this moment, but yet there would be a phased approach in case there is another phase for B2C, or there must be some thing which is announcing for tier 2, tier 3 specifically. And if I recall, tier 2, tier 3 ministry would be having this as a benchmark for the revenue. So yeah, that would be phased for B2B, and for the business to customers. So far, they're not having any strict mandate for the e-invoicing at this moment in UAE.
Okay, thank you. The next one is from Niranjan. What is the situation for import and export invoices?
Okay, that's it.
That
Yeah,
is what
very
he said. What
interesting.
is the
Very interesting question. I understood the question. So import and export of the invoices, I would like to address this. That's a cross-border trade. So for the e-invoicing cross-border trade, there are two options. Either you are sending the invoice to a region, to a country who is having this PayPal as a e-invoice framework? If yes, that's another situation. That means your buyer would be having a participant ID. As I mentioned, PayPal is not just for UAE, just for Malaysia, it's a global trade. So the buyer would be having a participant ID and you would be sending the invoice through your service provider, through ABC service provider, middleware. And in terms of import, if you are a buyer in UAE and you're getting some purchase, primarily they come from any region. So I would go for the option B, which is not a PayPal environment, just like in Saudi. So if you are getting an invoice and or you're sending an invoice to Saudi, of course you are having a participant ID as a PayPal member, but Saudi buyer is not having the participant ID. In that case, PayPal allows you to put a dummy participant ID and send that invoice. The reason is that if you are not having a participant ID for the buyer, you cannot get the invoice from corner one to corner two. That means your invoice would be somewhere stuck between PayPal network. It would not go to the buyer situation. So that would be an easier situation. Companies, their middlewares can just key in the dummy data for the participant ID that would go to the PayPal corner 4 and then to the tax ministries. So the buyer would just just receive and accept the invoice if they are not a PayPal organized region. So that would be the case. And yes, cross-border transactions are also a mandate for invoicing starting from 2026 July. Yeah.
Okay, next is from Tapas. Is e-invoicing also mandatory for POS sales?
That refers to the B2C POS sales. If it's B2C, then not at the moment. But if there are businesses who are managing the POS environment, because many of the B2B organizations are also having POS sales. So in that case, that would be a mandate.
Okay, the next one is from Sangram. Are we required to provide physical invoice and e-invoice both? Reason being, for internal audit purpose, we need stamp from the buyer of the goods. In the absence of stamp, customer doesn't pay the invoice. Or there should be a variance in the quantity. If there is any variances from the quantity billed and delivered. So how does this
Mhm.
work in e-invoicing?
That's a very interesting question, and that's not a common question, I must say.
Yeah.
So it's a blend of taxation and e-invoicing. Now, e-invoicing, if we defer to the other regions, Ashna, we do not need physical invoice for the audits. But I would like to keep this question open for the relevant tax partners in UAE, because if that's a mandate in UAE for the physical existence of invoice, then it needs to be there. But on top of my head, I believe if there is an e-invoice which is having a QR validation and the significant validation from the authorities, and then it is sent to the buyer by using the PayPal network. That means it's a self-explanatory thing that the buyer is genuine because it's having a participant ID. And then it's already approved and validated by the tax authorities. So yeah, audit is already done.
Yeah, I agree. Next is from Sudesh. Who needs to do invoicing and there are any limits?
I'm not sure if Mr. Sudesh is asking for what limit, but yes, if you are having million of invoices, you need to get validated million of invoices. If it's the invoice count per month or per year, because as expert advice in Malaysia, we have crossed some of the companies which are having per month quantum of a million invoices. So if your question is referring to the number of invoices, it depends on the organization. Every invoice should be e-invoice if it's B2B at this moment.
The next one of the questions is in Saudi, does submission of each invoice, like in Saudi, it has to be in Arabic. In UAE, are they suggesting invoices to be in Arabic as well?
Guess what? No. UAE is
Oh,
just a mandate for English. That's a pretty much saving thing for the, like I would personally say it's a savior for UAE. English is just a standard thing for invoice. Unlike Saudi, Saudi was having a mandate to get the Arabic language for the e-invoice. So UAE at this moment, because UAE is a business hub promoting the global trade, so that's why English is just a mandate. Yeah.
one of the questions asked is there any full form for PayPal?
PayPal, yes, there is a full form of PayPal. That's a very interesting question. We can also Google for this one. Anyways, I actually forget this term, but yeah, we can Google for this one. PayPal. It's a not-for-profit organization. I
Okay.
would help this gentleman. This is Pan-European Public Procurement Online. Yeah,
So there is a full form.
there is definitely
Uh,
a full form.
okay, one last question we will take from Manohar. And some of the organizations require submission of invoices through their portal. How does e-invoicing impact this process?
All right. If any organization is having their specific portal, they cannot connect to the tax authorities without using the PayPal network. So either big is the organization, they can, in terms of e-invoicing, they cannot directly go into the ministry's portal and get it validated. Because if a PayPal is a mandate, everybody needs to follow that mandate. And invoice can go towards and backwards using the PayPal framework only. Yeah.
Okay, there's one last question. This is from our Nasir ji. So, at what point does this validations happen, considering different tax periods? What point of time do we need to validate these invoices from buyer
Okay,
and seller?
so I understand. So invoice validation, there are two forms of validations. One would be the data validation, and the other one would be a logical validation. As I mentioned, there would be some corner 2 and 4 that would be accredited access points. So that would be managing the validation on your behalf. That means if you are sending an invoice and there is some missing validation, your access point would be getting it back to you saying that, buddy, this invoice is not getting the validation, cannot move to the next step because this would be the reason. Number one case. Second is that it is always a real-time validation for e-invoicing because PayPal framework promotes the real-time validation. Your invoice would be sent to the buyer and then to the tax authorities, providing the QR code in a real time. And just to share a quick success story for this other environments, which I'm closely working into, Malaysian environment, they have the real-time validations. And within, if I talk on numbers, within a minute or half, they can get the QR code and the unique identifier for the invoice by the tax authorities. So that's a real-time validation for the buyer and for the supplier itself. Yeah.
Thank you, Abdullah. With the context of time, and we have another session, so we'll limit the questions now. And fantastic, loved it. Got a brief overview. Still, a lot of challenges are there in this area, which will come to know only after this fully implemented. But I think there is a lot to prepare now besides just corporate tax. The next challenge is e-invoicing
Definitely, Ashna,
for all
and
of us.
there is a lot to talk. In fact, you give me just a bit of a chunk of a time for this invoicing, but it's a big ocean to cover. So I would
Yes.
suggest every taxpayer in UAE is that go get some consultant before time, get this regime onboarded with your ERP systems, and to the finance and the taxation teams. Personally, they would be the front leaders for this e-invoicing regime because once you are getting the data validation, you're good to go for the technical part. Teams can build the connectivity, but compliance should be there. So yeah, it's a one piece of suggestion for the audience that we are already happening to miss the bus if we are late for this e-invoicing adoption. So yeah, we are on a good pace. Thank you very much, Ashna, for your time, for support,
Thank
for
you.
the answers.
Thank you. Thank you so much, Abdullah.
Thank you.
So let us start with the next session. I don't want to take much of your time. So we have the next topic, which is the buzzing topic, which is first tax return. And we have two speakers with us who will be taking us through these sessions, which is Aarti and Pooja. Aarti is a senior manager with Deloitte Middle East and she's based in Dubai. Prior to working with Deloitte Middle East, Aarti worked with KPMG Lower Gulf. She has over 9 years of post-qualification experience in international tax and structures. With She's worked with different M&Es and she's currently focusing on the UAE corporate tax regulations. She'll take us through the entire deck of how what are the pointers that are there in the first tax return filing that you are going to be filing now before 30th of September 2025. A second speaker that is co-hosting her is Pooja Kabra. She's a manager, business tax, Deloitte Middle East. She's based in Dubai and she's currently focusing on the newly introduced corporate tax in regulations of UAE. She has over 7 years of experience in taxation. She specialized in corporate and international tax. Before joining Deloitte, she has worked with KPMG, so it's all Big Four experience. She has assisted large UAE and Qatar headquartered businesses in assessing and analyzing the impact of new introduced tax and BAPS in Pillar 2 as well. So let's have a engaging session. If you have any questions, I would request you to listen out to the speakers first and then post them on the chat box, and we can take it at the end of the session. Over to you, Aarti and Pooja. All the best.
Hello everyone. Can you see my screen and am I visible?
Yes.
Great. Thank you, Ashna, for a warm welcome and such a great introduction. Before that, thank you, Abdullah, for such a detailed and insightful session on e-invoicing. I think the UAE taxpayers have a lot to look forward to and prepare. With corporate tax and e-invoicing coming, I think it's a boost for tax professionals in the region. I would like to welcome everyone who has joined this webinar and taken out the time to join and listen to us on the UAE corporate tax return. Like Ashna already introduced, I'm Aarti Yadav, and presenting with me is Pooja Kabra. We appreciate your time today. In this session, we'll walk you through the corporate tax return. We'll try to break down the form, explain you each section, and highlight what you need to know to file your forms accurately. We'll try to address your questions towards the end of the session. Now, the corporate tax form is quite detailed. So our goal today is to make the return filing process a little more clearer and manageable for you. Before we waste any more time, let's just get started. Now, what's the agenda for today? Yeah. What's the agenda for today? Now, the session will be focused on three parts. We'll start with a very quick recap for the UAE, what the UAE corporate tax regime is. Then provide an overview of the return form, basically highlighting who needs to file, what needs to be filed, and what is the structure of the return. Followed by a detailed walkthrough of the corporate tax return form, which has various parts, and then the key takeaways. So going to the next, let's get started. Now, setting the scene. A quick recap. The UAE corporate tax law has been made effective for the financial year on starting on or after June 1, 2023. This marks the beginning of the corporate tax era in the UAE, requiring businesses to report and pay taxes for the first time. Now, this is, of course, outside the purview of oil and gas and foreign bank branches, which were always taxable. Now, all taxable persons in the UAE region are required to file the corporate tax return. The return is due within 9 months from the end of the relevant tax period, which is your financial year. So if you're following a December financial year, your return is due in September. Now, coincidentally, the first tax period that ended on May 31st, 2024, the due date is today to complete your tax filings. Now, when it comes to the payment of taxes, the due date is the same, which is 9 months from the end of the financial year. There are no quarterly or advance payments for corporate tax in the UAE, unlike VAT. So it's a single annual return and payment requirement. Now, there are consequences for not submitting the return on time or paying the dues of the authorities in time. There can be administrative penalties. So even if you're late by a day or you underpay, the Federal Tax Authority can impose fines. So timely and accurate filing is very critical. Now, for reference purposes, the FTA has been kind enough to publish detailed guidance to assist taxpayers, and there are two relevant guides. Firstly is the corporate tax guide on determination of taxable income, which helps taxpayers to understand how to calculate the taxable income and tax payable under the law. And the second one is the recently issued corporate tax guide on tax return, which provides you a step-by-step guidance on filling out and completing your tax return. So we'll be focusing and discussing on the second guide, which is the corporate tax guide on tax return today. Now, these guides are very useful references if you need more details on any part of the return or your calculations. But needless to say that these guides have to be and should be referred in conjunction with the federal tax laws and the decisions issued by the FTA. Now, with this background, let's move on to the UAE corporate tax return form itself and break down its structure. So what is a corporate tax return? Now, the UAE corporate tax return is structured into multiple parts. So you have various components, part A to part I, and each are capturing a different aspect of your computation and disclosure. So you need to provide detailed information and figures in part A to H, whereas part I is basically a supporting schedule where your detailed calculations will go and will be linked back to your initial parts. We'll go through each of these parts in detail in the coming slides. Now to the basics. Who are required to file? As I already mentioned, all taxable persons are required to file tax returns in the UAE. Now, a taxable person would include UAE companies, would include other juridical persons like foundations, even foreign companies with permanent establishment in the UAE or nexus in the UAE are obliged to file tax returns. Now, there are certain entities that are exempt, like qualifying investment funds or government control. So some of them may have a filing requirement just to notify about the exemption. What is important is who can file it. So a return has to be filed by the taxable person itself, which means the corporate entity. However, there can also be an authorized tax agent or legal representative who can file it on their behalf. For tax groups, the parent company is responsible for filing the tax returns for the entire group. Whereas for unincorporated partnerships, a nominated partner is responsible to go ahead and do the filings. Now you need to complete these filings on Emara Tax Portal. This is the same portal where all the VAT obligations happen. We have a separate section for corporate taxes. Now what is important here is that the UAE uses a self-assessment principle, which means that the taxpayer's responsibility is to ensure that the return is complete and accurate and that the tax is correctly calculated according to the law. So it's your responsibility as a taxpayer to ensure this information is correct. Now the Emara tax portal, the corporate tax return, is detailed and dynamic. So when I say detailed and dynamic, what do I mean? It means that it will show you the fields and schedules that are only applicable to you based on what you provide. So there's a certain input of data. Basis that input of data, they will show the fields and schedules that are important to you. Now this streamlines your process and tailors a form to each taxpayer situation, which also means that the accuracy is crucial here, right? The answer that you give early on at the time of registration is the one that will determine on what you complete. So what is important is that not only filing your returns correctly, but also your registrations have to be accurate and up to the date because they will directly flow into your corporate tax return forms. See, for example, if you have a wrong accounting period at the time of filing the registration, now that is going to be coming in your return and you will not be able to amend it without going back to your registrations. Now, the key point here is while the form is pre-filled, picks up information that you provide, it's at the end of the day the responsibility of you as a taxpayer that all information that you've entered are correct and that all sections that are applicable to are the one that is reflecting. Now, we have covered the basics. So let's focus on diving into a detailed section by section approach to see what is the corporate tax form comprising and what do we need to look at. So as already explained in the previous slides, we have 8 different parts in the return form and we'll go through each of these parts in detail going forward. Now, first is the taxable income information. Now, this may just sound as if basic information of a taxable person, but this is one of the most crucial part that every taxpayer should make sure is updated and accurate. And I'll tell you why. So part A of the return is all about taxable person's basic information. Now, this looks very straightforward and mostly is pre-populated based on what your Emara tax portal was provided with at the time of registration. So the pre-populated information will be your taxable person name as per your trade license, your TRN number that you were allotted while you were doing the registration and when it was approved, your establishment details, basically your address, contact person information, email addresses, your financial year, which again is your start and end and going forward tells you when you're due to make your payments and file your returns, your primary business activity, and the last but important, your type of taxable person. So you need to ensure that these informations in your registration information is accurate. So you don't have to manually input this, it'll basically be picked up. So always review this as a part of your registration, because anything that is incorrect in registration will be pre-populated here. And then you will have to go back and amend your applications on the submit a separate application called amend taxable person information to ensure that there are correct information. Now, something like an address is okay because you can do it even later, but something like a financial period will impact your return form. So it's good to make sure that your forms, your portal is up to date with the correct information. Now, on this note, I think it's a very good opportunity to highlight to you that as taxpayers, you are required to keep your portal updated always. So if there is a change that happens in your taxable person information, you need to make sure that you are amending it within 20 days. That's the requirement under the law. And if you don't do that, you can attract penalty. But the authority has recently issued a decision to waive any penalties till 31st of March 2025. So you have an open window to make sure that if your information is not updated or outdated, use this window to correct and rectify your information today. There will not be any penalty attracted. So I would recommend that if you go ahead, check your portals, ensure they're updated. Now, again, so that was on pre-populated information, right? So again, what type of taxable person we picked up? So important that you put it appropriately. So if you're a taxpayer, you will have to do a normal filing. But if you're if you're a tax group, then the tax group details and questions around that will be asked to you in the part A. Now, this is pre-populated. Then there are certain questions that you will have to answer that will be specific to the type of taxpayer you are. So if your type of taxpayer is inaccurate, your questions around that will also not tie in. So if you look at the category of taxpayers, if you're a natural person, then there'll be questions around confirmations about your residential status, your business activity, and your turnover. Now, again, turnover will be relevant because if you are a small business who wants to claim a small business relief, your amount here should be accurate to ensure that your corresponding schedules for small business relief are open and active for you. Now, if you're a judicial person or a tax group, you will have other questions that are relevant to you. For example, are you a part of a multinational organization, a multinational enterprise group? And I think one of the important point here is that these data, we believe that this data will be used for you going forward for your schedules and elections and your detailed computation, but also an information like are you part of MNE and your threshold and your revenue will be a data collection point for your for the tax authorities. Given that Pillar 2 rules are in practice and are going to be implemented and applicable from 2025, I think this is a good way for the tax authorities to collate this data, which can be questioned tomorrow. So if you're saying you're an MNE and you're crossing the threshold and you're not complying with your Pillar 2 requirements or notifications, there may be a risk and you can be questioned. So I think it's important that you do that exercise upfront to know where you stand today. Right? Another very key confirmation, which will be common across all tax payers, will be are you following cash or accrual accounting method? And this should also be answered correctly because based on your answer, if you're following cash or if you're following accrual, you will have the relevant election options and schedules active to you going forward in the remaining part of the tax forms. So taxpayer information may look very background and simple and just information type of a requirement, but this is the most crucial and starting point for you to commence your return form and make sure that you have accurate information and category of questions that are being asked and popped up by the portal to you. Now we move on to part B, which deals with any specific elections that are there and that can affect your tax calculations. Now, so part B is where you indicate any tax elections your company is making for the tax period. Now, tax elections are basically options under the tax laws that a taxpayer can choose. So it can have an impact on how your income will be taxed or how will the return be filed. Now, not every company will have an election option. So it's important that you check whether an election is available to you or relevant to you, because if that's not the case, then the field will not appear in the tax form. Now, under the tax laws, we have 6 election options. So we will discuss each of these election options now. Firstly, we have the realization basis. So if you prepare your financial statements on an accrual basis of accounting, you can elect to take into account gains and losses only on realization basis. Now, the law provides you options to select. So you can have an option to select all assets and liabilities that are subject to fair value and impairment accounting from an election perspective, or you can choose all assets and liabilities only on capital account for an election perspective. Now, important point here is that if you're a bank or an insurance company, then you may not have an option to select any one of those two. You may have to only select option B in that case. Now, what is the benefit of this election is that the gains and loss will be subject to only on a realization event. So when an asset is disposed of or a liability is settled, this election can only be made at that time. Now, again, this election can be made only in your first return. So it's an irrevocable election only available to you in the first return. So again, a very important point, because you need to go ahead and check and see whether you can benefit out of this election. Now, like I said previously, cash and accrual method is important. So if you are looking for cash, if you are a taxpayer with cash basis of accounting as your method of accounting, you will not get a pop-up or an option to go in and make the selection. Now, for tax groups, of course, the tax group will make an independent election. But if you are a member that had joined prior, so you will have to forfeit and follow what the tax group is doing. And if you're a subsidiary, again, who had taken a decision on an election from a realization perspective, once you join, you will have to follow what the tax group is basically opting for. Now, other than that, you have transitional basis election. Now, again, what is transitional election? What is election for transition basis election, to be more specific? So a law contains certain transitional provisions that can be benefited only in their first tax period. So there are provisions which allow you to adjust your taxable income to exclude any gains or losses related to prior years to your first tax period. Now, there are conditions attached to it. So this will not apply to all your assets. You will have to have a qualifying financial asset, liability, immovable property, intangible assets. Only these 4 categories are committed. And the other condition would be to make sure that they are recorded on a historical cost basis. Now, again, like I said, this election is available to you only in the first tax period, and this is an irrevocable election. So you have to make, and whichever year you're disposing of, the adjustments will be made accordingly. The important point here is that you cannot cherry pick. So if you're choosing a particular type of asset, the election will apply to all category of assets and liabilities in that particular section. Excuse me, sorry. So important to note, important to go and analyze to see if the transitional provisions and realization basis both are beneficial to you. And again, don't look at it standalone asset perspective or a specific transaction perspective. You need to look at it holistically from a taxpayer perspective from a financial perspective. So you need to look at a whole asset stream or a whole liability which are relevant under a specific head. The next one is small business relief. Again, it may not apply to a lot of businesses, but we all know that the law provides for small business relief, where businesses below 3 million threshold can avail tax benefit and basically an exemption until 2026. But you need to make sure that you're not a part of an MNE or you're not a qualifying free zone person. And if you are eligible for this relief, you will you will be given an option based on what you provide in your Part A. Now, the businesses that go ahead and make this election will be treated as not having any taxable income. And this is an annual election that one needs to make, which we need to opt annually. Now, what is good here is that if you're a small business relief making this election, the form gets much simpler because most of the schedules will not trigger and will not apply to you. So that's a welcoming move because a small business relief exempt income, low threshold can easily go and file without going through the complications of various schedules and paths. Now, the next elections would be the business relief. So we have an option to make elections for any transfers that we are making within qualifying group and elections for business restructuring. So there is a provision which provides them some reliefs. And if you want to avail the relief, we have to make an election. Now we'll cover the relief in detail in the next, in the coming slides. But what is important from an election perspective, that these elections are again irrevocable. So you are required to make it in your CT returns in the year of your transfer or your business transactions, and you cannot go ahead and do it later. So again, if you have transactions, make sure that you make an election and complete the relevant schedules. Lastly, but important one would be the foreign PE, foreign permanent establishment exemption. That's election that is there. So the law provides you an exemption where you can decide on how to treat the income of your foreign PEs. Now, the law allows a foreign PE exemption means you can go ahead and exempt your foreign branch profit from tax in the UAE. So you exclude that income from your UAE taxes. Subject to it being, there are certain conditions that it's already being taxed and things like that. Now, what the form will do is it'll ask you whether you have a foreign PE and do you meet all the conditions and do you want to make an election. So if you say yes, you will exclude the income. But if you say no, obviously it'll be subject to tax in the UAE. Critical important point here is that you need to make sure that you are analyzing this for all your PEs because you cannot cherry pick this election. So if today I am electing my one branch, to take an exemption, we'll apply to all my branches. So you cannot choose one branch. The selection will apply to all equally. So before you go ahead and apply for the exemption, I think it would be a good exercise for you to do an analysis to what benefits you more. Like if you're a branch in a high tax country, the exemption makes sense to see if you're going to avoid double taxes or not, right? So I think today it would be good for you to do the number crunching, check the calculations and the data, and then go ahead and see what elections you would like to make. So in conclusion, any elections that were already made, so it'll apply going forward, and that is not available to you will not show up in your return forms. So and as you would see, there are some elections that can be made only in a first taxable period, like the transition relief and realization, and some you can make it like small business relief on an annual basis. So if you're missing something or if it's irrevocable or already chosen, you will not see those options on your return form. One important, I think, and a practical point would be is before filing and going ahead and concluding on your election options, tax professionals specifically should go and discuss with your finance teams on the elections that they're going to make. Practically, because these elections may have a long-term impact, right? You don't know when you're going to be transferring your asset from a transition perspective. If you're doing a realization, you have to take into account the differences that you're going to be having from a books perspective, and you need to maintain those records. So they may have long-term impacts and will require you to have internal documentation in place. So get those approvals, align with your finance teams beforehand, and then go ahead and finalize on your pros and cons, and of course, make your elections. Now we move on to part C, which is accounting schedule. So where we need to provide the financial data for the company. So now what is part C? Now think of this as providing the tax authorities a snapshot of your financial statements. So this section is about reporting your accounting income and your key financial statements figures. It is part of the tax return form, but it's for disclosure purposes only. And anything that you will not be inputted in your computation as such. Now there are 4 key elements over here. First is the income statement. So here you will report your total revenue and profits as per your income statement. For the year, now what you need to put here is your revenue, cost of goods sold, your other income. So I think that's the focus. Again, you'll pick this up from your financial statements. Then you have statement of other comprehensive income. So if you have other comprehensive income which is not going to classify to your P&L like a revaluation gain or fair value gains or investments, then you need to complete and compile that information over here. Then you have the statement of financial position, which is technically your balance sheet information, like your assets, your liabilities. Again, if you're following cash basis of accounting, you will have limited information. You have to only complete your income statement, whereas for other taxpayers, you'll have to provide all. Important is that if you're doing a filing as a tax group, then you will need to complete the accounting schedule based on your consolidated financial statement of the tax group as a whole and excluding any entities that are not members. So you need to pick up the data from there and put it here in the sheet. Last is the audit information. Now, audit information, they will question and they'll ask you if you are audited. Now, this will be pre-populated if you are a qualifying free zone person or if you cross the threshold, which is 50 billion dirhams. Once you do, though, you also have to indicate who audited your financial statements, the name of the auditor, whether the auditor's opinion was qualified. Now, the auditor must be a UAE registered auditor. Now, lastly, the currency. We all know that the currency has to be AED. So if you're using another currency, you'll have to convert it using the guidance provided by the authorities and show the amount in dirhams. You will have to put whole numbers. So technically, the nearest dirham in your financial statements. Now, in summary, Part C is just reporting what your financial statements will look like. So there's no tax calculations here, right? It's a starting point for your next part. But you need to make sure that the numbers align and are tying in with your audited financial statements or financial statements as applicable. The accounting net profit you report here is crucial because Part D will be your starting point. It may not automatically pick up, but you may want to have the same number indicated there. So once we have the accounting information, I think the next step will be to reconcile the accounting numbers to your taxable numbers. So Part D, this is where the work actually starts, right? So Part D is where the real calculation begins. So we start with the accounting income, which obviously we indicated in Part C, but we have to manually input again in Part D. Then apply various adjustments as required by the corporate tax. And once you make those adjustments, you will arrive at the taxable income. So we account for even the exempt income in these schedules. Now think of this part of the return form as how do we get from the accounting profit to your taxable profit, right? So you will have your starting point as your accounting income. Now this section will include all your adjustments that are going to be linked to various schedules, right? So if you have a particular adjustment where you need to provide more detail, it will take you to a corresponding schedule. And you'll have to make the adjustments accordingly. Now, again, this option for the component for the adjustments vis-a-vis the schedules will depend on the type of taxpayers. So going back to Part A will depend on how accurately you have answered your Part A. Right. The starting point would be for a regular resident individual would be your standalone basis, your standalone financial statements, right? For a non-resident individual like a PE, it will be the income attributable to your operations in the UAE. For a tax group, you have to make sure that your aggregated profit of the whole group is your starting point. Now, basis this, you will have to complete, you'll have to indicate the adjustments, right? Now, say for example, you're doing an equity accounting of method, equity method of accounting, you'll have to make certain adjustments. If you're a partner in in an unincorporated partnership, who's electing to be a taxable person, you will need to adjust the income attributed to as a partner to avoid double taxation. Now, if you're choosing to treat your gains and losses on a realization basis, so you will need to go ahead and complete the schedule to provide the appropriate information around unrealized gains and losses and complete the schedule so it can be appropriately populated. Now, so the adjustments will be properly populated from the relevant schedules. So it's important that your relevant schedules are appropriately completed, like exempt income. So if you have, say, exempt income, the dividend from subsidiaries, you will say yes, and then the relevant number which is coming from your pre-populated dividend schedule should appear here, and they will automatically make the adjustments to exclude that from a taxable income. Now, we have a lot of adjustments which you can see on the screen. And again, they're specific to the type of taxpayers. We'll discuss 3 of these adjustments in the slide for information purposes. Now, so firstly, there are accounting adjustments to be done to arrive at the tax figures, right? So say if you're an investment which follows equity method of accounting, what do we do? So we firstly determine whether the investments are accounted for under the equity method of accounting. If we say yes, then the share of profit or loss from investments have to be excluded. And any dividend that you're receiving will be included. But there will be a corresponding adjustment coming from the dividend schedule because you will be required to complete a dividend schedule. Depending on whether you're receiving it from your foreign company or a domestic company. Now, if your investments are not accounted under equity, there are no adjustments required. No need to go and complete any specific schedule for adjustment purposes. Similarly, if you have an exempt income, right? Now, when we select, yes, we say we have exempt income sources, right? So then dividends and profit distributions from UAE entities, which don't have conditions attached to it, will be auto-populated from the UAE dividend schedule and adjustments will be made appropriately. If we select for any income or also participating interest, again, there are conditions to be fulfilled. You will require to populate the details in participation exemption and the taxpayers, and of course, it will be pre-populated from there. Now, you also need, so in the participation schedule, if you are no longer meeting the requirements, you are required to go ahead and complete those informations as well. Next would be the PE. We already discussed that if I'm making an election, you have an option to exclude. So now here is a time where you make the adjustment for it, right? So if we assess that we are a taxpayer, we have a foreign PE and we have selected for the exemption, what happens is when we say yes, the income and expenditure related to this foreign PE will be excluded from our taxable income. And this will actually come from your foreign PE schedule. So it will be auto-populated. So you are required to fill that schedule. And if you select no at the time of election, the standard rules will apply and the income will go ahead and be taxable. Now, after inputting all the relevant adjustments, you will see your adjustments before your relief because we're just talking about for certain accounts. Now, what is very crucial here, right? What is crucial is accuracy. So accuracy in your schedules. So if there's no accuracy, there's a mistake in your schedules in your part A, there will be issue with what you're getting as an output. So this section ensures that you're only taxing what you should be taxing. So if you make one mistake here, it's going to directly impact the tax calculation. So accuracy is the key, checking is the key, making sure that the information in the prior schedules are appropriately entered. Now, once the part adjustments are done, the next section, which is part E, is about reliefs. So in terms of reliefs, we already discussed in the previous slides that we have election options to choose whether we want to go ahead with reliefs or not. Now, part E deals with the relief provided. So reliefs are provisions that allow you to reduce your taxable income under certain circumstances. Usually it's to recognize legitimate business transactions between group entities without having an immediate tax cost. Now, there are two main reliefs that are there under the UAE law. First is the qualifying group relief, and then we have the business restructuring relief. So let's break this down. So, sorry, says that anyone? Okay, I think, okay, no worries. So qualifying group relief is basically the first type of relief covered in this section. Sorry, somebody has a question?
I
think so. You should mute all.
Can we mute, please? Yeah.
Okay, no worries, that happens. I'll just get back. So first is the qualifying group relief that we will start with. Now, so if you are transferring certain assets and liabilities within the same qualifying group, sorry, I am unmuted myself. Sorry, I'll go back. So if you are a qualified group relief is basically where you are a part of the same qualifying group and you're transferring assets and liabilities. Now, to claim this relief, the entity must elect for it. So you need to make an election in Part B. And only when you're doing that, you'll be able to provide the details about the relief. So if the election is not made, the standard tax treatment will apply. That means any transfers between the groups will also be taxable, even if you're fulfilling the requirements of a qualifying group. Now, again, this may not apply in the first year, but going forward, I think it's important that if the election is made, we need to determine whether there is a clawback event in the future year. So if you're making a claim this year, or say, for example, you need to ensure that if there has been a clawback and you have failed to fulfill the requirements of the law, you will have to complete the disclosure requirements. Now, what is the clawback event? Clawback event is when an entity that received the relief no longer qualifies or disposes of the assets within the prescribed limits. So if the clawback triggers, a tax relief granted will be reversed. So something that is not taxable will now become taxable for you. As part of the obligation to report the transaction, the relief report, basically the transaction has to be reported not only by the transferor, but also by the transferee. Now, for the transferor, if the election is made and there is no clawback, the relief remains in place and you move on doing business. But if the clawback conditions are met in any year, and then the gains and losses from the transactions must be disclosed and accounted in the tax returns. For the transferee, I think receiving the asset that was subject to relief, it must be reported in the qualifying group relief. And if the clawback relief if the clawback triggers, the tax impact will also be adjusted for the transferee equally. Now, in the event of clawback, you will also need to make certain type of adjustments have to be reported. There can be disclosures depending on when the clawback occurs, right? So if you need to disclose information around unrealized gains on the assets, what was the gains on the asset that was previously disposed of, any depreciation that happened on that assets since the transfer, and any other adjustments that is in pursuant to the transaction between the entities. Now, so these disclosures are important. Why? Because any tax relief claim in prior periods are tracked and reversed appropriately. So in simple terms, if I have to explain, the conditions for relief will remain intact. There'll be no immediate tax consequences subject to all conditions being aligned. However, if there are conditions changes and there are clawback even that triggers, there are subsequent adjustments that you will have to make in the subsequent tax periods. Now, we have the business structuring relief. This is more or less in line with what we discussed for the group relief. Now, business restructuring relief is a little different in terms of what it is. So basically, it's a transfer of business, a merger, or transfer of unit between entities and would trigger a taxable gain, but that will be tax neutral if you fulfill all the requirements. Now, like I said, the requirements are the same for both the reliefs. You have to continue reporting the requirements. The reporting will not only be on the transferor, but also on the transferee. You will have to look out for the clawback provisions and do appropriate reporting and disclosures. Key point here is that both parties should be consistent. So if you're the transferor and you're electing the relief, the transferee must also disclose it and report it. So in summary, with both the relief options, both parties, transferor and transferee, are liable to be reporting. They should be consistent. Now, these reliefs will help business manage their tax liability efficiently without transferring assets when transferring groups assets within the group, right? However, you come up with this is within additional compliance obligations. So these entities will have to track down that their elections are made. If they are made, track down the clawback events. If there are any clawback events happening in the subsequent, make proper disclosures to remain compliant with the UAE tax regulations. Lastly, these are elections. So these mean that you are actively choosing to apply for them. They're not automatic. The form requires you to respond yes and no and ensure you're consciously confirming each of these responses, right? They are irrevocable, which is very, very important. They are irrevocable elections and reliefs. So if your transaction has occurred in a particular year, say in the first financial period, you are supposed to make the elections and make disclosures and claim for reliefs because there's no retroactivity that you can do it later. So I think that is a key element which every business should keep in mind when they are looking and preparing themselves for the first compliance period. Now, I would like to invite Pooja to take you through the other adjustments. So the better part is coming and Pooja will walk you through the other adjustments.
Thank you, Aarti, for such an insightful and I would say a detailed discussion. Particularly, I would say the way you simplified the restructuring relief with that flow chart. Now, I'll take it forward from here. So now part F, which is the other adjustment, this part is applicable to all the taxable person. So till now, if you see the way we have discussed is we reported our accounting income. We discussed about the election, the relief available, the exempt income. So basically we were doing the adjustment basically which will not be like offered to tax or which will basically decrease your tax book income to your taxable income. Now when we come to this part, which is other adjustments, so as we know, when we are doing the computation of taxable income, we will have to do certain adjustment to your book income, and this adjustment may have an impact of increasing your book to basically your taxable income. So Aarti, if you go on to the next slide, please. Yeah. So on the other adjustment, on the left-hand side, what we have is the interest expenditure. So if we recollect, there are two sort of interest deduction limitation rule under the UAE corporate tax law, which is the general interest deduction limitation rule and a special interest deduction limitation rule. Needless to say that when a taxpayer is a natural person, bank or insurance provider, because of the exclusion provided under the UAE CT law, GIDLR calculations would not be applicable. They will need to be tested only for special interest deduction limitation rule. So with this, we come to special interest deduction limitation rule. When it applies, basically, when a taxpayer has taken a loan from its related party, and such loans were used to make the repayment for the dividend, for the repayment of the capital contribution to the shareholder, and of course, not meeting the other conditions as are prescribed under the UAE CT law, such interest expenditures would be disallowed. Once this disallowance is considered under special interest deduction limitation rule, then the balance net interest expenditure of a taxpayer needs to be tested for general interest deduction limitation rule. Now, general interest deduction limitation rule would kick in when your net interest expenditure, it exceeds AED 12 million. If that is the case, then that one would have to complete the interest capping schedule. When we come to interest capping schedule, of course, we'll have to provide a lot of detail. But one that we have to bear in mind is we also provide the details of the interest, which will have to be excluded while we do this interest reduction limitation calculation, which is basically, 30% of EBITDA or AD 12 billion or whichever is less. So, as you know, under the UAE corporate tax law, there is a grandfathering provision. Basically, if there is any interest expenditure which pertains to loan taken prior to 9 December 2022, such loans are grandfathered. Therefore, such interest expense will have to be excluded when we do the general interest reduction limitation calculation. Once all these details are provided in your interest capping schedule, the schedule will automatically calculate the disallowable interest expenditure. Now, if we come on to the right-hand side, there's a list of non-deductible expenditure. So basically, this is the schedule where we'll have to put our details with regards to non-deductible expenditure, and it will basically increase your book profit to taxable income, and there would be a upward adjustment here. One and the most common one being the entertainment expenditure. Now, as we all know, in the case of the entertainment expenditure, only 50% of the amount that you incur for your customers, shareholders, your supplier outside your office premises, only 50% is allowed, and the net 50% is disallowed. So the disallowed portion, we will have to report it here. One important highlight that I would like to make here is if you have seen the guide, in the guide, as Aarti stated earlier, this form is quite dynamic. So when we are completing the accounting schedule, there in the income statement, we will have to put the details of the entertainment expenditure. So what explicitly has been clarified in the guide here is the amount of the 50% of entertainment expenditure that you put here. Basically, it cannot be less than the 50% of entertainment expenditure that we have put in the accounting income schedule. So it is very critical that when we are filling even the accounting income schedule, basically just not matching what your accounting, basically your net profit is matching with your financial statement, also ensuring there's a correct classification of the expenditure when you're putting in the accounting income. Then the next one is the non-deductible pension contribution. So as we know, if a taxpayer today is making any contribution to private pension fund, only the amount that is actually paid would be deductible in the current tax period. Anything that is paid in the subsequent tax period would be disallowed in this year and would be allowed in the subsequent year. So you will take into this as a disallowable expenditure in this year. And also needless to mention that, there's a capping limit here. Only the 15% of total remuneration of employee can be taken as a deduction. So anything exceeding 15% is actually a permanent disallowance. The third one, which is quite obvious one, I think, that the charitable donation that you make other than to a qualifying public benefit entity, again, that's what is disallowed. The interesting one is expenditure incurred for deriving exempt income. Again, it is not something that will be easily available from your financial statement. A computation will be required to be undertaken when you have, say, both an exempt income and your taxable income, and a proper allocation will have to be maintained. The documents supporting everything will have to be done before you start filing your tax return. And then the remaining list, as you can see, is expenditure that has not incurred wholly and exclusively for the purpose of business, basically pertaining to personnel or pertaining to any other probably related entity that you have taken as a deduction or as expense in your financial statement. And then the common one being the dividend distribution, fines, penalties, bribe, and all such expenditure. Now, if we move on to next slide, please, Aarti. There are also some other adjustment. On the left-hand side, these are the basically adjustment related to when you're making a transaction or payment with your related party and connected person. This I'm going to anyway discuss in more detail in the subsequent slide. So I'm not going to go into detail for this at this moment. But if you see on the right-hand side, we have some other adjustments such as the taxpayer say is an investor in a qualifying investment fund. So qualifying investment fund being a transparent entity, such income and expense will have to be considered in the tax return of the taxpayer. Therefore, the taxpayer, it is assumed that they will get all this detail from the qualifying investment fund about the different categories of income, such as basically their net share from the rentals, from the interest income, from the exempt income, and so on. Please bear in mind that when you're receiving the dividend itself would be taxable. So you will put the details here, but you will also have to complete the dividend schedule basically to claim that exemption. Again, quite a lot of details that would be required when you start preparing your return if you are an investor in a qualifying investment fund and something which will not be easily available. So you start basically collating these details. Now is the right time, I would say. It's still not late. And the other adjustment pertains to prior period errors. As we all know, this is not something that's going to apply like for the first tax period. This is something that would apply from a second year onwards. Say when in the previous period returns that you have filed, there was some errors and this error is less than 10,000 dirhams, then in the subsequent tax period, this adjustment can be made. So basically, these are the adjustments that we will have to report to derive our taxable income. So with this, if we move on to the next slide, please, Aarti. Yeah. So Part G talks about the tax liability and the tax credit. So basically, this is the part, or this is the section where the taxpayer will see its final taxable income and the final tax liability. Also, again, there are related schedules that need to be completed. Just an example, if you are taking today a foreign tax credit because of any income that you have derived outside the UAE, there's a withholding
Oh,
tax
I'll
on
just
such
fix
income.
them. So we'll ask them to issue everything by tomorrow. That's all. They can, if small things are not there,
Sorry,
they can really make some
someone's
workings
mic is.
and, link it. The non-process, everything they can do. It's not easy. So the normal TP will be there, one small workings.
Pooja, if you can unmute yourself, I have muted everyone.
No, but honestly, sir, I don't want them to do patchworks also.
Not patchwork, it's not patchwork, something.
Okay, Pooja.
Yeah. Okay, so as I said, this will be basically the section where our tax liability, final tax liability, and the final taxable income would be computed. Of course, there are related schedule that needs to be completed. For example, if in case you have a taxable income and you're utilizing a tax loss from any other your related party, from basically your group entity, tax loss schedule needs to be completed. If you are taking a tax credit for the taxes that you have paid outside the UAE, you will have to complete the tax credit schedule. Again, the tax credit schedule is not like quite a simple schedule. For example, if I just take a simple example of withholding taxes, they are generally on a gross basis. Whereas, as you know, for the foreign tax credit, there's a limit that basically the tax that you can avail is only the 9% of your taxable income here in the UAE. So you will have to calculate the net income, which will be net of your expense against that income. Again, this calculation will have to be done per jurisdiction wise, per income wise. So another calculation or schedule, I would say, that has to be kept ready if you want to avail this benefit. So once you have calculated your tax liability, basically you will be able to, once basically you submit your tax return, it's only then when you will be able to get the link for this payment of the tax liability. And that's how the taxpayer will discharge their tax liability once they file the return. Even this tax liability will be have to be discharged using that link. So with that, Aarti, if we move on to the last part, which is on part H, which is on review and declaration. Some breather here. There are no final financial calculation which are required in this section. It is simply basically reviewing the tax return completely holistically, making the declaration, whatever you have provided is correct. So some of the key aspect, as you can see on the screen, would be on the filing date, the date when you're filing your tax return, who is the return preparer, basically it's a taxpayer, tax agent, legal representative. In case it is other than, of course, the taxpayer, you'll have to provide the confirmation that you have the authority to make such submission. And finally, it is a confirmation or the acknowledgement to say the details that you have provided, they are complete and accurate. So with this, technically we will complete from part A to part H. Now, when we move to part I, now which is on the schedules, and I'm quite sure by now you have been quite overwhelmed with the word schedule as we have used it quite long during this session. But as my colleague she moves on to the next slide, you would appreciate why and why there's so much about the schedule. As you can see, there are almost like a 20 schedules that are part of this tax return. But as has been clarified earlier, it's not the taxpayer will have to complete each of this 20 schedule, depending upon the benefit that you're taking, depending upon the conditions where you fall, depending upon the disallowances that are applicable in your case. These schedules will have to be completed. But please appreciate that though it might be that only few schedules are applicable to you, but these schedules are quite a detailed one. And what we put in here in this schedule is something that will go to your main computation of your taxable income. So since there are a lot of schedule, and in the interest of time, we will just try to cover few of the schedule. And the most obvious one would be first of all on the free zone schedule. So Arti, if you can go on to the next slide, please. Okay, so as I rightly said that the free zone schedule again will be only completed by the tax person who wants to take the status of wants to take the actually the benefit of qualifying free zone person and benefit from the 0% corporate tax rate. Free zone schedule again quite a detailed one, can be divided into two parts. When you see on the screen, the first part mainly it focuses on the revenue. Again, on the revenue, the way the section is flowing, it is something in line with our corporate tax regulation, the ministerial and cabinet decisions. But again, it's not something a detail of the revenue that you see in the financial statement. It's quite a detailed revenue by breakdown that we have to give. So if we see, the first part would be your total revenue. Then you start providing the each of every detail, whether you have any revenue that is attributable to, say, your permanent establishment, which is attributable to your immovable property, to your intellectual property. Once you provide this total revenue details, then we have a non-qualifying revenue, which a taxpayer has to provide basically if it is relates to any excluded activity in case of non-qualifying activity with a non-free zone person. So once we complete the section A and section B, that's when the section C under this de minimis calculations will be automatically run by the schedule. And needless to say, if we don't meet this calculation in here, then you will not be able to take this benefit for this year and for the next 4 years. Lastly, if you are able to meet this de minimis calculation, you will complete your qualifying revenue, which is the most important one, because this is the revenue for which you'll be able to benefit from the 0% rate. Again, a breakdown of the revenue has to be provided. So with this, if you move on to the next slide, Aarti, the remaining part of the free zone schedule, it covers mainly on the substance requirement and on the confirmations that we have to give. Again, with regards to substance requirement, it's a quite a detailed one where you firstly give the confirmation that all your free zone employees are actually located in a free zone, which is again something not coming from a regulation, but yeah, this is sort of a confirmation that has been requested. Then in case your CGAs have been outsourced, you give a confirmation that you have adequate supervision. With regards to outsourcing, you have to provide a lot of details, the name, the TRN, expenditures that you have incurred, the employee details, and so on. And the two last and the most important one, you also have to provide the details about average number of full-time employees, one, and average number of employees in the free zone. Average means the opening and the closing in a particular tax period. This is something that we will have to input. And the last one is the total operating and the capital expenditure in deriving the qualifying income. If you remember from the even from the previous slide when we were discussing, we'll have to maintain this breakdown. Even in the free zone person, you'll have to maintain the breakdown of your expenditure into one incurred in deriving the qualifying and deriving non-qualifying revenue, because that's how your net qualifying income would be calculated, which would be then subject to 0% tax rate. And the remaining one is section F is on the free zone confirmation, where you give the confirmation, which these conditions are pretty much same to the condition that we have for the qualifying free zone person, that you have a substance, you have a related party transaction compliance, transfer pricing documentation, audited financial statement. If you give a negative confirmation to any of this, you cannot take the free zone benefit. Lastly, on the additional information, quite interesting one, for a qualifying free zone person, you have to give a detail of your EBITDA and your payroll cost Emirates by Emirates. This is something that is only particular to free zone, qualifying free zone person. But yeah, you will have to give this detail. This is again not something that is coming from the law or from the regulations. Lastly, for the benefit actually for the taxpayer, there is also any additional information fee. This can be used by the free zone person. As we know, currently this is the first tax period. There are quite a peculiarities involved when a free zone person claims the status of a qualifying free zone person. So if there is any basis that you have used, you can use this field to justify your case. So with this, I'll just we will move on to the next slide to just summarize some of the key action point or checklist when it comes to free zone person and completing this free zone schedule. First of all, before filing the CT return, please undertake the assessment. You meet the entire all the condition throughout the tax period. Before CT return, also ensure that you have the documentations with regards to your substance, also from this free zone authorities that you're actually a free zone, you have the free zone status, the return declaration or confirmation from the free zone that they are free zone purchaser, that they are the beneficial recipient, they meet basically the beneficial recipient of the goods and services, then the bifurcation of the expenses. These are some of the key criteria that we have tried to list here, which will help you basically like a key checklist that these all should be done bare minimum to take this benefit. So with this, if we move on to the next slide, please, there's another schedule that we would like to cover, which is on the additional like attachments. This has been quite a common, I think, discussion around in the market that whether we have to upload the financial statement. The answer is yes. Uploading financial statement is one of the mandatory thing to be done to be able to submit your tax return. Again, there's an exception for a small business relief, but otherwise it's one of the mandatory field. Other documents, as you can see, they are optional. But of course, today, if you're taking the benefit or falling into particular condition, though it's optional, it is recommended that you submit it right at the time when you're submitting the return. For example, today, if you're taking a FTC benefit, please submit your supporting document right away, because as we know, the authorities will come asking you for the supporting documentation. So this was with regards to the additional attachment. If we move on to the next slide, which is with regards to the transfer pricing disclosure. So with regards to transfer pricing disclosure, there is already like at the outset, there are a lot of details that we have to provide. But one welcoming move or the much awaited detail was with regards to the thresholds actually, when the schedules have to be completed. So as you can see on the screen, there are two schedules, related party schedule and the connected person schedule. But always remember the thumb rule when it comes to related party and connected person transaction is it has to be at arm's length. And in case of connected person, the payment should be in accordance with the market value. I'll quickly go through the threshold as in when the schedule has to be completed. So there are two thresholds actually, primary threshold and a secondary threshold. So for related party transaction, the primary threshold set is basically 40 million. And the way it is tested is you will have to look at aggregate value of all related party transaction recorded in your financial statements or at a market value exceeding 80-40 million. If that is the case, you complete the schedule. And the only transactions that are required to be disclosed are the transaction with related parties where the aggregate transaction value per category exceed 84 million. The 7 categories are prescribed, which is being pertaining to goods, services, IP, interest, assets, liabilities, and others. Also, please note that the dividend between your related party will not be considered as a part of this, both the threshold, the primary threshold and the secondary threshold. And with regards to the connected person schedule, again, there is a primary threshold, which is the CP schedule, will be required to be completed only if aggregate value of transaction with at least one connected person, it exceed 85,000. If that is the case, again, what we disclose, any payment or benefit exceeding 85,000 per connected person together with all its related party, that must be disclosed. So if we quickly go on to the next slide, in the interest of time, I think I'll just quickly walk through what the details are and the important one. When it comes to the related party schedule, the basic details, of course, would be your name of related party, transaction type, the tax residency. But please note that the details that you have to provide, the number here is actually the gross income or expense pertaining to that transactions. And this would be compared with the arm's length value, which will have to input into the schedule, and then the tax adjustment will be calculated. When it comes to connected person, important one is you have to disclose the name of the connected person along with the services that they have provided. Again, we provide the value that we have provided to the connected person, the market value, and then the system will calculate the adjustment with regards to the connected person. Please also bear that when it comes to the related party, apart from this automatic adjustment, there are also some manual details which are required to be filled in the other adjustment part. It can be like upward adjustment, downward adjustment. Even though you have the adjustment automatically calculated in RPT and CP schedule. But when it comes to other adjustment part, we will have to manually put those details in here. So a very quick key aspect on the next slide with regards to this related party transaction, though there's a threshold provided, please ensure all the related party transactions are at arm's length. Also, since we have to know the market value to determine this 40 million thresholds, FTA wants to basically they're trying to put as much as check possible to ensure that your transaction with a related party are at arm's length. And lastly, with regards to the connected person, as you can appreciate, the threshold is very low. So the taxpayer basically might end up reporting all its transaction with connected person in the return. So with this, I will hand it over to Aarti to summarize the key takeaways and the important deadlines. Over to you, Aarti.
Thank you, Pooja. That was very detailed and very structured. I am sure the audience are overwhelmed with the details that we need to provide as part of the tax form. But that is the reality of the tax form. The form is very detailed, and there is a lot of collation of data that you need to do prior to going ahead and filing your returns. So, given that, I'll just change the slides. Yeah. So, in the interest of time, I'm just going to quickly highlight on the key takeaways that are there. This is the first filing tax period, right? So everyone is going to be lost. Everyone is going to be lost, not knowing what to do. But the FTA has been kind enough to give these guidances and give the report forms, which are very clear and provide a structured approach, right? And what information needs to be filled and what not. And as already discussed, the form may look very huge, may very lengthy, but it triggers depending on what kind of taxpayer you are, what kind of option are you going to select. So that's key. Your key is accurate submission of information. That is the key, and collation. Now, when I say collation, it's basically ensuring that there are no last minute challenges for you. You analyze your data, you collate your information, get into details because you need to provide details. If you like Pooja already showed you, the qualifying free zone is getting to nitty gritty of each and every items, right? So you need to focus on you need to focus on small items over here. Transfer pricing is also very detailed. So you need to make sure that your transfer pricing disclosures are made accurately. Now, all this has to be done in time, right? You have a deadline to adhere to. You can evoke penalties. So don't do anything last minute. What I think the focus areas for each of us as taxpayers in general, it may apply to some, it may not apply to some. Firstly, in my experience, would be the qualifying free zone persons, right? We are getting a 0% claim, and it's very important that you have an internal policy and a process in place to make sure that you have the requisite documents, because so that nobody can challenge your claim tomorrow, right? And even of audit, today we're providing confirmations, but it's better to have supportings in relation to the computations handy. Otherwise, there can be issues. The adjustments, right? Data, there is a lot of data that the firm needs. The firm needs you to provide your financial data as is from your financial statement, the adjustments, the corresponding details regarding your adjustments. So it's important that you do that exercise today, right? It's easy for me to say, but as company, as businesses, you will understand the pain of pulling out this data if you push it to closer to due date, right? Get it done today, get those adjustments, do the necessary comparisons, as in what you're looking for and what you want to go for. How is it beneficial to you? Have a forward-looking approach. When you're making elections, when you're making adjustments, make sure that you know that you're going to be fulfilling the conditions for a certain period of time. And if you have a possibility that you may not, take a call internally whether you need to, you need not be. Next is private clarifications, very undermined by corporates. But if given it's the first year of law, given the law provides you a provision for clarifications, if you have the ability and you know that there is a gray area, you know that your position is not tight, maybe you can approach the authorities and get a private clarification that can help you strengthen your position. So there is still time for certain taxpayers and they can go ahead and do this. And the FTA is clarifying, is responding. So I think that would be another key important takeaway for all our corporates. The next one will be monitor the guidances, the clarifications coming from the FTA and the MOF. Ask your consultants, check the portals. Reason being, it's a first year. As taxpayers, we are learning, but as the authority, they are also learning in the process. They are open to listening, and they are bringing in changes. So we can expect changes around. We can expect more clarifications coming in from the authorities, even on the portal. So we can wait and watch, because I think they're trying to make it user friendly. So we can expect updates. So regular monitoring is another key element. And this goes without saying, right? Have adequate and robust documentation. I mean, I think documentation is the key for your compliances. The more robust your documentation, the better you will be in handling your compliances in the future and going forward. So you do the first year correct, your following years will be much easier. Deadlines. I think I'll just make this very quick. I know we're running short of time. We've already over time. We already have deadlines for registrations. We have deadlines basis of the trade license for foreign PEs. For PEs, we have a separate deadline. Please make sure that you are abiding by those deadlines. People forget when they're a new juridical person that they have short deadline, like 3 months. Not unlike the entities that were pre-CD era. So make sure that you are complying with those on time. Grouping, the major chunk or the December end has already passed by, but there are entities that are following April to March. The deadline is coming very soon. If you don't apply for the group application by your deadline, you lose the first year as a tax group. So keep these deadlines in mind, abide by them, submit your applications. Uh, and yeah, and the return, and of course your return may be due in September. Do a reverse planning to see when you want to start with your financials, your computations, your adjustments and collation. That is very critical when it comes to compliances. And like I already mentioned, documentation is the key. I'll hand it over to Pooja. She'll guide you on what are the critical things that you should, in our experience, keep it handy when it comes to your first city compliance period. Pooja, over to you.
Yes, Aarti. I think I'll just make it very quick again. We have just provided a list of critical documentation, given that it's a first tax period, first tax return filing that would be due. As you can see on the screen, there's already a list of critical documentation, of course. There are a number of documentation that's still required to be maintained. Just to take a few examples, it would be with regards to your revenue and expense, maintain the appropriate invoices, maintain the agreements so that you can claim the deductibility of your expenses, ensure they are properly recorded in your financial statement and your books under the current ledger head. Secondly, of course, financial statement. I cannot emphasize enough on this. If you have already breached the threshold provided for the audit, you will have to have audited financial statement. Also, if they are not in AED, we'll have to convert it into AED. Similarly, on the interest expense, if you're taking the benefit of grandfather clause, you will have to have a loan agreement, QFZP. We have already discussed it enough. A lot of documents that needs to be maintained. Transitional relief, though we had covered it in the previous slide, what the relief means, but to be able to take that, you need to have a valuation report that will be for immovable property, financial assets and liabilities, since the valuation is of the first day of your tax period. Related party transaction, needless to say, everything needs to be maintained: intercompany agreement, invoices, functional analysis, benchmarking study. I even saw a question in the chat. I think someone is even asking that do we have to submit this benchmarking study and the functional analysis? No, we don't have to submit it. Currently, you just have to maintain this as a documentation. Of course, in the future, when the authorities ask, you will have to submit it. But also appreciate the fact that in the related party schedule, you are today submitting the method that you are applying. So you will have to have a supporting documentation to support your case. Foreign tax credit, I already have touched based upon it, that so it's optional. If you are taking the benefit, you will have to support the supporting, be it the tax withholding tax certificate, the tax payment challan, and all of this. So with this, we have come to end of our webinar. I would really like to thank you everyone for your time and the patient listening. In the interest of time, Ashna, I think we can take one or like two questions if the time permits.
We'll take a couple of questions, but before that, thank you so much for the insightful session. I can see 200 people still glued to their screen, which tells that they didn't want to leave a single slide. It was so informative. Thank you both. Thank you to both of you. Amazing, Aarti and Pooja, really. But I would request our ExCom member Sanjay, who wants to take us through the questions. So let us take members' questions. Sanjay, can you tag in?
Yeah, thank you, Ashna. And I think I must add, like Ashna said, Puja and Aarti is the mark of beginning of something auspicious, right? And today, the way you explain the corporate tax is really marvelous job you've done it. So let me take up the few questions. I think some of the very interesting question again we have seen on the screen. First one is about what about the pension contribution of 2023 paid in 2024? Will it be allowed as a deduction? This is for you, Pooja.
Yes, Sanjay. So I think with regards to pension contribution, again, it's quite an interesting question, and this is only not particular to pension contribution. I think it also has to do some other expenses that you were related to your prior tax period, as in your pre-tax era. So it is assumed that you had, the financial statement that you had prepared actually were in a sense subject. We say that it was your taxable income. So already you have taken the, I would say, the net taxable income for it. So again, it's not something that will be allowed in the subsequent year. And also, I think it's quite logical to say that it was never disallowed like in the previous year. So if you remember during even my discussion, I was saying that it's a temporary disallowance. You do the disallowance in 1 year and then you take the allowance in the next year. So that's how the logic flows. So for 2023, I think the simple answer would be that it would be assumed that you have already taken this in the previous year. There was no disallowances made. So it will not be like a double deduction in 2024.
All right. And next question is about the financing fees, like arrangement fee, commitment fees. Will it be covered as a part of the interest definition, or will it be excluded? I think again it has to go with the IFRS, right?
IFRS, I would say, Also, sorry, Aarti, if you want to take it up.
No,
Yeah,
I think I was just saying that I
Aarti?
think it's not a very straightforward one, right? You need to also see what the arrangement comprises of. There is a specific MD which discusses interest reductions, talks about what can be included, and we need to go ahead and see how do we fit this within that definition. If we don't, if it doesn't fit, then of course we will not look at the interest provision and we'll just follow the IFRS rules. So I don't think it's a sorry, Abhishek, right? It's not a straightforward one. We will have to look at what your arrangement looks like to be able to commit and tell you. But in simple terms, you follow the books, right? And if you want to go to something very specific, you need to look at the definition to see how well you can fit that in there. I hope that helps.
I mean, the auditor must have like more role to play is how they will treat it, whether it's going to be like a treat as an interest cost, it has to be go as a like amortization. That has to be also play critical role there.
Correct, I agree. But also there is a MD, right, which specifically discusses on what can be your interest, like a return on lease, which has got some interest element attached to it, can be taken as interest for the purpose of your EBITDA calculation. So we again, like I'm saying, again, it's very wide enough. But principally, what you're saying is absolutely correct. We follow the IFRS, what the auditor says.
Correct. Okay, next one is again very interesting. Taxability of the reversal and write-off or write-back of prior period balances in the current year financial 2024-2025. So what's your take on it? Write-back or return or write-off of the previous year account receivable. So what to do with that? If we write back the excess provision of the last year in 2024, would it be considered as a taxable income? That's the question. That's what I assume from that.
Okay. Okay. If I vaguely remember, the guide specifically has a provision to say that you follow what your books are doing. So if your book is allowing you a deduction for this, you go ahead and follow it. Whereas same thing applies for your income. But again, you will have to look at how it's going to affect your current taxable income. Right? There is also a write back of a price. Okay. So again, the treatment is same. If you're allowing a reduction, you're giving a claim. So that should be the way you go ahead with this.
All right. So you're saying it's going to be again going with the audited numbers, right?
Yes, we follow the IFRS. That's the specific thing that the guide is clarified. During the.
Okay. The next one is what about the shareholder loan? What about the interest on the shareholder loan deduction? Pooja, you would like to take it up this one?
Yes, actually.
Interest on the shareholder loan?
Yeah. So if the way actually I had covered this point already in my special and limitation rule. When you have the loan from the related parties, there are special interest deduction limitation rules that need to be tested. Basically, we test whether you had the purpose that you took the loan and the reason that you're taking the repayment. Basically, if there are certain conditions on the criteria provided, if say the capital contribution, and also there are further adjustment attached to it that basically the 9% taxable rate. So when you will have to look cumulative in all this requirements, if we today don't, as in if you fall in any of this condition, this is a straightforward, it's a disallowance. Again, it's a permanent disallowance, unlike general interest reduction limitation rule that we see can be of a temporary nature.
All right. Hello.
Yes,
Yes,
sir.
Sanju.
Continue.
Yeah.
I can hear you.
Yeah. So next question is about whether father paid management remunerations is 81 million and son paid 80 to 50K, then both needs to be disclosed in the CP schedule.
I think the key again goes back to first of all doing the assessment to see who the related party is, who the connected person is. Are you falling in the connected person definition? Again, how the schedule has been prescribed. You have to check it per connected person. So not quite a straightforward things under that I can give you a confirmation of a yes or no. There's a pre-assessment that needs to be done for this. Where do you fall, whether you fall in a connected person, and then that's how we answer. And also then we look at all the payments and the connection, payment that has been made to these particular people.
Okay, very interesting question. One more is, can we claim benefit of transition rule for the sale of right of use assets? I'm not very much clear. Can we claim benefit of transition rules for sale of right of use of assets?
Goes back to accounting.
Yes.
If Does it qualify as a financial asset? Does it qualify as a financial liability from an IFRS perspective? And it is booked at the historical cost. That's where you will start to be able to confirm whether it's a transition relief or not. And I'm not sure if right of use of asset can fulfill any of these requirements. But like I said, not an accounting expert. You have to go and check with the auditor to see if it's a financial liability or a financial asset. Liability in this case, yeah.
Yeah. All right. So more and more responsive on the shoulder of the auditor this time.
Yes.
What is the capital expenditure? As every year we don't have capital expenditure. If we had not done any capital expenditure year 2024, what to mention? Okay, this is about the disclosure part. In qualified free zone section, they're asking what is the capital expenditure as every year if we don't have any capital expenditure? Let's say what to disclose there. I mean, nothing, right?
Yeah, ideally we have
They
basically
don't
you have to
have,
put
yeah.
both your operating and your capital expenditure. And as I said again, it's just a bifurcation, Sanjay. It's not simply that you can today put forward your capital expenditure entirely in there. But yeah, if there's nothing, then I'm sure you will at least have operating expenditure because keep in mind that's one of the key conditions that you incur the expenditure to earn your income. If that is not the case, then you are at a risk of losing the free zone benefit.
All right.
Maybe
Yeah,
in the
that's
interest
just a
of time, we
critical
can
point.
take one more question, Sanjay bhai. In the interest
Okay.
of time. Last one question.
The last one question. So prior period expenses debited to profit and loss account, whether deduction allowed? Pooja?
I think it's something similar to what Aarti also covered
Yes,
it
yes.
earlier. Yes, Sanjay. So basically, the corporate tax law, the basis is currently the IFRS. You follow the IFRS, and there are certain specific disallowances that have been provided. You again check what this prior period expense relates to. Example, if it relates to a fine, penalty, something, I cannot give a straightforward answer that it would be still allowed. So you will have to check the underlying why did this prior period expense arise and what it pertains to.
All right. It depends, right?
Yeah.
Thank you, Pooja and Aarti. It's a pleasure just listening to you. And I think over to you, Asna. Thank you.
Thank you once again. Fantastic session, and questions will always keep pouring. But everybody is learning at the stage. Everybody, there are a lot of gray areas as well. So FTA is still waiting for responses. So yeah, thank you very much. And weekend is just kicking in. So everybody wants to now rush home and enjoy the weekend. Rishi bhai, would you like to pitch in?
Yes, hi
For the
Ashna.
closing
Thank you very
remarks.
much, Aarti, Pooja, and of course Ashna, Sanjay. You all have made it, I think, a very memorable, I would say, event because touching the weekend, basically the thinking goes towards, where are we going in the evening? But then listening to the update, these which you wanna make you feel a little easier, like, okay, we have been struggling with these concepts. At least I've got something to relax and think about. So that way, I think, thank you very much for taking us through this session. And I'm sure a lot of notebooks must have been filled. Now it's time to fill the stomachs and enjoy rest of the evening and have a great evening. And thank you very much and have a beautiful, awesome evening with all of you. Bye bye for now.
Thank
Thank you,
you.
Ashna.
Thank
Thank you,
you.
Sanjay.
Thank
Thank
you,
you, Rishi,
Pooja.
for hosting us.
Bye bye.
Uh,
Awesome. Super.
Thank
Thank you,
you.
Rishi. Asna, and rest of the people.
So I'll close the call now. We'll have the recordings in case somebody missed it earlier and we'll share it with you later on. Thank you.